Communications power ahead by over 2%, lifting the S&P 500 into the green despite a tech-heavy Nasdaq drag in today's sharp sector rotation. The VanEck Semiconductor ETF dropped 1.6%. Lab scores 49. Hold. The fund's component index jumped 8,230 points, inflating its NAV dramatically and widening the spread. That surge overloaded short interest metrics, forcing sellers to capitulate. In the full teardown, we dissect how that spike rewires margins, supply chain exposure, and the next price catalyst. The VanEck Semiconductor ETF fell 1.59% to $590.77, triggered by a structural liquidation in memory chip hardware. While the fund boasts an astronomical year-to-date gain of 8,230.3%, drop exposes its concentrated vulnerabilities. Mainstream media blames macro headwinds and general market exhaustion. The lab tracks the actual physical supply chain to find a real driver. At a 5.8% weight, Micron, ticker MU, is taking the direct hit from this memory chip sell-off. This hardware pressure occurs just as Samsung begins mass production of its PM1763 SSD. This new drive is optimized for next-generation AI infrastructure. This enterprise SSD launch alters competitive dynamics. It threatens margin profiles across the entire storage landscape. We analyze these hardware shifts to cut through the marketing narratives. Meanwhile, Taiwan Semiconductor, ticker TSM, at 9.2% weight, remains the sole fabrication bottleneck for advanced silicon. Nvidia, ticker Nvidia, dominates the ETF at a massive 17.8% weight. Its computational dominance keeps the fund's short-term trend bullish. The short-term trend is bullish based on the MA20 versus MA50 moving average alignment. Currently, the relative strength index sits at a neutral 44.7, indicating balanced positioning. This technical support structure remains intact despite memory chip sell-off. The heavy concentration in Nvidia and TSM makes SMH a pure proxy for global AI capital expenditure. This memory volatility will shake out weak retail hands while institutional capital continues funding the physical hardware build-out. Open the hood on the VanEck Semiconductor ETF. The largest single dragging, MU at minus 8.0%, carrying 5.8% of the fund. VanEck sells the SMH Semiconductor ETF as a diversified sector play. That is marketing fiction. Just 5 stocks control 43.9% of this entire fund. Nvidia alone commands a massive 17.8% weight. Taiwan Semiconductor sits at 9.2%. While marketing brochures promise broad exposure, the actual holding composition reveals a highly concentrated hardware bet. This structural concentration explains why SMH beat peer fund SOXX by 2.9 percentage points. While equal-weighted peers like XSD plunged 15%, SMH outperformed XSD by 6.3 percentage points. The lab tracks this design efficiency. While its AUM and expense ratio remain undisclosed, no fee drag can obscure these massive returns. It pairs Micron at 5.8% and Applied Materials at 5.7%. This captures both the memory and wafer fabrication equipment bottlenecks. Advanced Micro Devices at 5.4% rounds out the top 5. At a 3.63% Fed rate and CPI at 0.6%, capital demands efficiency, not dilution. With unemployment at 4.2% and a normal yield curve at plus 0.4%, macro stability favors pure-play growth engines. This design bypasses legacy chip drag. It channels capital directly into leading-edge silicon manufacturing. The proof is in the performance. SMH delivered an astronomical YTD return of 8,230.3%. This dwarfs its 3-year average of 57.1%. The fund's DNA proves that diversification is often a fee-extracting myth. The lab's verdict is clear. SMH is a highly concentrated, precision-engineered weapon built for absolute hardware dominance. SMH is trading at a 1.5% discount to NAV, while the 5-day volume is 26% below the 20-day average. That's not a correction. That's institutional capital stepping back. Outflow is the signal here. Retail is chasing the YTD 82% rally, but the big money is booking gains before the next tariff headline hits. The discount tells you exactly where sentiment is. Retail is still long. Institutions are not. The narrative machine is running full tilt. Semiconductors are the new oil. AI demand is insatiable. Geopolitical moats protect margins. Here's the PR decode. VanEck is selling diversification, but the top 5 holdings, Nvidia, TSMC, ASML, Broadcom, AMD, represent 58% of the fund. That's not diversification. That's a concentrated bet on AI capex and export controls. The narrative ignores the hardware reality. TSMC's Arizona fabs are delayed. ASML's EUV shipments to China are still frozen. And Samsung's PM1763 SSD is mass-produced in Korea, not Texas. The supply chain is global, but the policy risk is local, and the fund's weighting doesn't hedge it. RSI at 44 and price below the 20-day MA confirm the momentum shift. The lab's verdict. SMH is a liquidity proxy for AI euphoria, not a structural semiconductor play. The discount and outflow are the real signals. Institutional capital is rotating out before the next tariff tweet. SMH has gained an astronomical 8,230.3% year-to-date, completely outperforming the broader Nasdaq benchmark. This massive run is anchored by the upcoming launch of Nvidia's Blackwell architecture chips. Tech giants are aggressively securing limited manufacturing space at specialized factories like Taiwan Semiconductor to fuel this upgrade cycle. Nvidia and Taiwan Semiconductor represent a concentrated 26.9% of the fund. This concentration directly captures the highest margin slice of the hardware stack. However, structural headwinds threaten this momentum. U.S. export controls to China directly restrict the revenue potential of top holdings Nvidia and ASML. Concurrently, high interest rates make the capital loans needed for domestic factories incredibly expensive. Any escalation in military tensions around the Taiwan Strait remains the ultimate risk, halting global chip production instantly. Now, look at the technical setup. The RSI sits at 44.7 with bearish MACD momentum. Meanwhile, the Fear and Greed Index signals extreme fear at 25. Extreme fear historically precedes ETF bounces. Watch for capitulation signals. If SMH breaks below key support at $561.23, then expect capitulation to trigger a deeper institutional sell-off. If the fund clears resistance at $620.31, then the Blackwell launch is officially priced in for the next leg up. The lab rates the VanEck Semiconductor ETF of 49 out of 100. Do not buy this exposure at current valuations. Rational investors must hedge this volatility by pairing SMH with a defensive dividend ETF to protect capital. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 330%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. SMH's 49-point hold score came straight from Nvidia's CoES yield cliff. That's the signal that moves markets, not earnings hype. Where do you see SMH in 30 days? Up, down, or flat? Drop your call. This isn't financial advice. We're engineers breaking down hardware, not stock tips. Do your own research. Past performance never guarantees future returns, and always weigh risk before trading. Hit subscribe so you catch the next die level breakdown before Wall Street wakes up. The lab's closing the books.